Welcome back to the Funding Blueprint. Today we're thrilled to have a distinguished guest with us, Paul Spitz. Paul has an impressive journey that combines law, business, and entrepreneurship, making him a powerhouse in the world of corporate and transactional law for startups and small businesses. After earning his undergraduate degree from the University of Michigan and his law degree from Boston University, Paul began his career practicing corporate law in Boston. With 7 years of legal experience under his belt, he decided to pivot to the business world and pursued an MBA in marketing from Indiana University. His diverse career took him through various roles, including a stint in San Francisco, where he owned a picture framing franchise. Despite the challenges of the 2008 recession, Paul leveraged his business acumen and legal expertise to establish a law firm focused on startups, entrepreneurs, and small businesses. Now with over a decade of experience running his own law firm, Paul supports a diverse portfolio of clients across multiple industries, including software development, marketing, SaaS, e-commerce, cybersecurity, grocery delivery, and alternative transportation networks in Latin America. His practice specializes in corporate and transactional work, such as forming corporations and LLCs, drafting and negotiating contracts, commercial leases, preparing website terms of use and privacy policies, startup financing, and merger and acquisitions. Based in Cincinnati, Ohio, and licensed in both California and Ohio, Paul serves clients nationwide and internationally. We're excited to delve into his wealth of knowledge and experience today. Paul, welcome to the show.
Hi, nice to be here.
Awesome. Happy to have you here. I want to kind of dive right in and start talking about launching your startup is exhilarating, but there are crucial decisions to make right from the start. One of the most significant is choosing the right legal structure. While both C Corps and LLCs offer limited liability protection, they cater to different business models and growth aspirations. The path you choose can significantly impact your fundraising potential and future exit options. So Paul, let's delve into the world of C Corps versus LLCs for startups. What are the key advantages and disadvantages of each structure, particularly when it comes to attracting investors and planning for a potential acquisition or IPO?
Yeah, well, there's really, the way I put it is there's two types of companies. There are companies that are what we think of as tech startups, and they are typically on a path where they're going to try to raise venture capital financing and scale very large and either have a big sale of the company or they're going to go public. That's kind of the trajectory that they're on. And for those types of companies, the default choice is a C corporation. Then there's everything else. And this is everything from your neighborhood dry cleaner to a consultant, maybe a marketing consultant or something of that nature, or it could be a freelance developer, a restaurant group that owns a variety of different restaurants, or other types of businesses that don't really fit the tech startup definition. And size isn't really an issue because you can have some very, very large LLCs, which is the default choice for these other types of businesses. You can get very big as an LLC. You can raise a lot of money from various sources, but they're just fundamentally different. So for those types of companies, the default choice has been the LLC.
Right. No, those are some great points. I mean, I think for startups in general, I think C Corp is really the best way to go. I mean, I think it's possible to have a startup in LLC, but if you're getting VC funding or any type of funding, I think just from a smooth transaction standpoint, I think C Corps are definitely the way to go. So I couldn't agree more with you on that.
I'll talk a little bit about the advantage of having the LLC, and what people like about it is that you set it up and then you just go run the company. There isn't a lot of corporate governance and management formalities that you have to deal with. You can put those kind of structures in there, like a board of managers and officers. You can certainly do that, but you don't have to. And so that kind of flexibility is really attractive to a lot of people. Where it gets complex is from a tax perspective, because they're pass-through entities, and particularly if you have more than one owner. Then they're taxed under partnership tax law, and partnership tax law can be freakishly complex. On the corporate side, you have, with a C corporation, a very well-defined management structure. You're going to have your officers that run the business day to day. You're going to have a board of directors that the officers report to, and the board of directors has kind of strategic oversight of the company, and the board of directors will approve and elect the officers. They'll have to approve certain large decisions. And then the highest level is the stockholders, who appoint the board of directors and may need to vote on certain transactions as well. But typically, the idea is that the stockholders aren't intimately involved with the business. Now, with your typical startup, the stockholders and the board of directors and the officers, it's all the same people. And they're you may have 3 or 4 people involved, and they're all wearing multiple hats, and they're all involved at all 3 levels of management.
Exactly. Right. No, those are some great points. Imagine your startup is, as like a newly built house, right? Because it really is, if you think about it. You poured your heart and soul into its creation, but to truly function and thrive, it needs to have a solid foundation. So for startups, that foundation is built on essential legal documents. Now, these documents establish ownership, they outline the decision-making processes, and they protect your business interests. So Paul, let's explore the essential documents every startup needs. We'll dive into what they are. The Articles of Incorporation, the operating agreements if you're an LLC, and the bylaws, and unpack their specific purposes in keeping your startup on solid ground.
Sure. So on the LLC side, it's pretty simple. You're going to have the Articles of Organization, which is generally a pretty simple document that you file with the state, and that's what forms the company. And then you'll have an operating agreement, and that's a contract among the members that is really, really important, because it's going to define who are the members, how much of the company does each of them own, how is the company going to be managed? Is it going to be by all the members or just 1 or 2 of them? What are those roles and responsibilities? What level of decision making do the members have? So some decisions could be, a majority vote. Some decisions could be a supermajority vote. Some decisions could require unanimous approval. And you can have all of that and mix them all in, because you have that flexibility. And then you'll spell out in the operating agreement how profits and losses are going to be allocated among the members. And then it's really good to have transfer restrictions, so that one of your LLC members can't just go out one day and sell her ownership interest to some stranger. The company would have a right of first refusal to buy that back. So that's really what you have on the LLC side. On the corporation side, a lot of those things are more structured and they're more embodied in corporate law, rather than things that you put in a contract and that you have a lot of flexibility with. But with a corporation, you're going to have your certificate of incorporation. That's what you file with the state. It forms the company. It specifies how many shares of stock you're authorized to issue, and some other, important organizational things. You'll have bylaws, and these are kind of like rules for holding meetings of stockholders, holding meetings of directors, other corporate governance matters, and they usually track corporate law pretty closely and embody corporate law, but you can deviate, you can put in some other bells and whistles and things. For a lot of these small, new startups, the bylaws are kind of overkill. You're going to operate a lot more informally than what the bylaws will lay out, but it's good to have them. That structure for growth is there. Every stockholder in a startup should have a stock purchase agreement. And, again, this is going to, document how many shares the person has. And I've certainly seen situations where the founder said, oh, we'll get to that later. And then 5 years down the line, they haven't actually issued stock to anybody. And there's disputes over, where are my shares? And if we issue them now when the company has a high value, what does that mean? Do I have to pay $30,000 for the shares now? So you want to have that stock purchase agreement, and you want to do it pretty quickly. And there's certain things that should be in there which, we can talk about, such as vesting and a right of repurchase and transfer restrictions similar to what you would put in an operating agreement. And then the last kind of must-have document for a tech startup is an intellectual property assignment agreement. And that's an agreement where the founders, and basically anybody that's going to work for this startup in a technical role, is assigning any intellectual property that they create to the company so that the company owns it. And, when you have venture capital investors sniffing around your company, interested in it, that's what they want to see. They want to make sure that the company owns all of its intellectual property, the patents, the copyright, the software, all of that. And so having everyone that joins the company sign one of these intellectual property assignment agreements is just absolutely important.
Couldn't agree more with you on that. We just recently formed our C Corp, and the first thing that I did was obviously have all those agreements set up in place. It's better to get rid of it, and do it as quickly as possible rather than delay it and then focus on it and deal with the problems that come with it due to you forming it and doing it late. So 100% agree with you on that. I want to move on. I want to talk about equity for a second. I think it's important. We spoke about a lot, from a founder to founder perspective. I want to touch upon equity. The initial equity split among founders is a vital decision, but it doesn't end there. As your startup grows and attracts talented individuals, you'll need to determine how to fairly distribute equity to non-founding team members. Now, this can be a tricky negotiation, and balancing rewarding valuable talent while maintaining the founder ownership. So, Paul, let's tackle the sticky situation of equity splits for non-founding team members. What are some of the effective strategies for determining a fair allocation, considering factors like a role, the experience, and long-term commitment for the company's success?
Yeah, well, there's a lot of ways to do equity, and probably the laziest is there's 3 founders, let's split it 33, 33, 33. That's just, it's lazy. And you need to take into account a lot of different things. Is somebody working full-time versus someone else working only part-time on the startup? Well, the person working full-time should probably get more equity. Is somebody putting in a lot of money versus someone who's just doing labor? Maybe the person putting in money should get more equity. If somebody is in doing, a key element of the software development, that needs to be reflected in equity. So everybody's bringing different things to the table. And then to make it more complicated, what's important today may not be as important 8 months from now. So, on day one, software development may be really important. And then 8 months later, connections with investors and the ability to raise money from investors may be more important. And then a year down the line, maybe marketing is more important. So you have to kind of balance these things and take them into account and have some flexibility. That's for the founders. Then you've got these people that come in afterwards, maybe to do a specific role, maybe user interface on the website or something like that. And you have to go out and use your Google search or Bing or whatever you use and see what kind of the benchmarks are, because there are some sort of standards out there in the marketplace. For example, with advisors, typically the advisor gets somewhere between 0.5% and 2%. It's very unusual to give someone in an advisor role 10% of the company. That would just be out of whack with what the standards are. So you really have to think carefully and intentionally about it and do a lot of research.
Couldn't agree more with you on that. Yeah, most of our advisory team is I'd say 1%. And I think, correct me if I'm wrong, from a board of advisors standpoint, I think 0.25, a quarter or 0.5% is traditional from an advisory board perspective. Unless someone can really contribute an insane amount of value, then you can kind of renegotiate that standard. But to my understanding, the advisory board is anywhere from a quarter to 0.5%.
Right, and the other thing you want to consider is you're only asking the advisor to make a commitment of maybe 1 to 2 years of time, and maybe only an hour or two a month. So while their contributions are valuable, the quantity of their contributions and the duration is much lower than somebody that's engaged full-time with the company.
I want to move to the vesting that we spoke about earlier and start talking a little bit more about that. Let's give an example. Imagine there's a startup, tech company that's developing a revolutionary new app, right? Now the founders are the initial programmers who poured their night and weekends building the core code. Vesting is like a stock option plan for these early developers. They don't get all the shares, the ownership up front. Instead, they earn them through time as they contribute additional features, fix bugs, and help the app gain traction. This incentivizes them to stay on board, to keep coding and to ultimately help the app become a market leader. This is just an example that I threw out there. There's many founders out there that are not tech-based, and this example doesn't necessarily apply to them. But in simplest terms, vesting is you working for your equity. You don't get that ownership up front, but it comes through time once you really live up to the company's expectation, deliver the value that you're supposed to deliver. So, Paul, with this startup lens, let's talk about vesting. What exactly is vesting, and why is it so crucial for startups to implement vesting schedules to align incentives, manage their risk, and keep their core team members invested in the long-term success of the company?
Sure. So what you described is forward vesting, and actually reverse vesting is far more common. And with reverse vesting, you get your stock all at once, and you own all of it on day one. And there's important tax reasons why that's beneficial to everybody involved, to have all of that stock on day one. But the way it works is you have to stay with the company and keep contributing, because if you leave the company has a right to repurchase some or all of that stock at the original purchase price. So, for example, you have a co-founder, gets 2 million shares and stops working after 6 months and just, kind of disappears. You don't want that person to own 2 million shares of your company if they're no longer involved. It's fundamentally unfair. So it gives the company the right to repurchase. And the typical vesting schedule is that 25% of your shares will vest at the end of the first year, and then the remainder are going to vest on a monthly basis for 3 more years. So if you leave at the end of the first year, the company can repurchase 75% of your stock and you keep 25%. If you leave after 2 years, you keep 50% of your stock. And so what that does is it prevents the company from having dead weight on the cap table in terms of people that aren't involved that have a large amount of stock in the company, and it allows the company to get shares back for people that just aren't working out. I actually happen to find that first year cliff is what they call it. The stock that vests after 1 year is called a cliff. I find that kind of unfair because you could work like crazy, days, nights, weekends for 11 months and 29 days. And then your co-founders say, we don't like the way you dress. We're going to terminate you. And you lose all of your stock, all of it. And the company has all of your contributions, assuming you sign the IP assignment agreement. So I kind of find that unfair. I would prefer to see maybe quarterly vesting for that first year. But there are some expectations, some standards in the startup world. So, it's not very common. The 1-year cliff is a lot more what you would see and what investors are going to expect.
Right. No, those are some great points. Moving forward to talking more about the 83B election form, which is really more of like a hidden gem. Not a lot of people actually know about the 83B election form, and I recently discovered about the 83B election form. So launching your startup is like building a race car. You and your co-founders are the engineers. You're pouring your heart and sweat into the creation, but before you hit the gas and race towards success, there's some legal paperwork to consider. One concept you might encounter is the 83B election. It's like a tax pit stop you might choose to make early on, not mandatory, but potentially beneficial depending on your situation. So Paul, let's delve deep into the world of 83B election forms for startups. So what exactly is it, and under what circumstances would a founder decide to make this election and potentially pay taxes upfront on their stock options?
Right. So whenever you get stock or options that are subject to vesting over a period of time, the default method of taxation is as the stock vests, you owe tax on the delta between what you paid for it and what it's worth on the day it vests. So going back to that situation of that cliff where 25% of your stock vests on the 1-year anniversary, if your company is on a growth trajectory and the value of that stock is significantly higher 1 year after you received it, when that first 25% vests, you could owe taxes on that. And depending on how fast the company has grown, you could owe a lot of taxes. So what the 83B election does is it allows you to say, I'm going to pay tax on day one on the difference between what the stock is worth and what I paid for it. And typically on day one, the day you bought that stock, there is no difference. It's zero. So it's kind of this, in many, many cases, it's a no-brainer. Of course you would want to do this. There are some cases that I won't get into where maybe it isn't a great decision, but really almost everybody is going to want to make the 83B election. And that should be the default. The default should be that that they treat it that way and you can opt out. But that's how the tax code is. And the kicker is that you have to make that 83B election within 30 days of the date that you receive the stock. So you buy the stock, do the 83B election at the same time, mail it in right away. Don't wait, because it's a use it or lose it. It's not 31 days. It's not 35 days with an apology. It's 30 days. And if you put it off, you're going to forget about it. You're going to forget to do it. And then you're going to have to pay money to someone like me to fix it for you. And it's not it's not something that you want to have to pay extra to fix. So that's what the 83B is. Typically, if you're dealing with one of the startup platforms, where they do the incorporation, or if you're dealing with a good startup attorney who has experience in this, when you get the stock purchase agreement, you're going to get the 83B election form and instructions as to what to do and when to do it. And pay attention to those. Fill it out, send it in. You'll be happy.
Yeah, no, for sure. I just had my team do this actually recently, so I think it's a big benefit for many startups because you'll get taxed on the fair market value then, And you can pay taxes now, as opposed to paying taxes in the future on that current fair market value. So I couldn't agree more with you on that. Let's fast forward and let's talk about the QSBS, which is another hidden treasure that not many people know about. Is this tax break called a Section 1202 QSBS that significantly reduces the capital gains tax burden if you strike gold with a successful exit. But not every startup qualifies as a QSBS. So Paul, let's explore the exciting world of QSBS. How can, one qualify for this tax break, actually benefit founders and investors? And what are the specific requirements a startup needs to meet in order to be considered a QSBS?
Yeah, this is a tremendous tax benefit for tech startups, and it's another reason why you would want to do a corporation, a C corporation, and not an LLC, and not an S corp, because only C corps can issue qualified small business stock. And I'm going to try to not go too deep into the weeds because it's a tax thing, and I don't want to put any of your listeners to sleep, particularly if they listen while they're driving. It would be very bad. So I'll give sort of a treetop overview of the QSBS stock. Basically, if you buy your stock from the corporation, from the C corporation, directly, and the corporation has less than $50 million worth of assets at the time, and you hold that stock for 5 years, it's qualified small business stock, QSBS, Section 1202. You don't have to file some kind of a document, and get a certification. You get it directly from the company. The company has less than $50 million in gross assets, and you hold it for 5 years. So your founding team, typically the stock that they're going to get is going to be eligible for this, provided they hold it long enough. And if you do, if you got QSBS and you've held it for 5 years and then you sell the company, the first $10 million of capital gains on that stock, tax-free. So it's really a tremendous, tremendous tax break. And when you're dealing with your investors, they'll be very interested in getting stock that qualifies as qualified small business stock. So, of course, later rounds where your assets may be more than 50 million, you may not qualify anymore. But those early investors, maybe at the Series A, even the Series B stage, they may want you to put something in the deal documents, that their stock will qualify as qualified small business stock, assuming they hold it for 5 years.
I actually didn't know about that. I mean, I heard of the term, but I didn't know that it was so beneficial, so advantageous to a team.
Oh, it's amazing. And, when I started my firm 10 years ago, there were other law firms and lawyers in Cincinnati that were kind of routinely setting up tech startups as LLCs. And figure, we'll convert them later. And I'm thinking that's malpractice or borderline malpractice. Because let's say you start out as an LLC and 4 years later you convert to a C corporation, and then 1 year later you sell your company for $100 million. Well, you've only got 1 year of your holding period for QSBS. So you've lost that tax break. You've basically wasted 4 years as an LLC.
Moving on to fundraising in particular, I want to talk about safes and convertible notes for a second. Because, you can't always go the equity round. Sometimes when you have no determined valuation, you go down the safe, simple agreement for future equity, which is a very nice tool created by Y Combinator, if anyone was interested in learning more about that. And also the convertible notes. So I want to dig deep into that. Deciding how to fuel your startup's growth is crucial. and yet nuanced decision. It's, unlike flipping a switch, there's no one-size-fits-all approach. There's safes, there's convertible notes, and preferred stock. Each offer distinct advantages. Now, safe notes are like early access passes for investors. They grant them the right to convert their contribution into discounted shares later when the company takes off. Convertible notes, they function more like flexible loans that automatically convert to equity at a predetermined valuation or upon achieving specific milestones. So they have maturity dates, of course. Preferred stock, on the other hand, it creates more of a tiered system with some investors becoming power users who receive guaranteed payouts and potentially more voting rights in exchange for a larger investment. So Paul, with this funding landscape in mind, let's explore these options in more detail to help you identify the perfect fuel to propel your startup towards success.
Sure. I actually don't see convertible notes very much anymore. Before about 5 to 7 years ago, they were pretty much the default option for early stage investors. And they had the advantage of being pretty quick and easy to do in terms of getting, in terms of the deal documents, the legal expenses, getting the investors to sign. And the way they work is the investor invests a certain amount of money, and then when you do a financing above a certain amount, typically like above $1 million, where you issue preferred stock, the invested amount converts into that preferred stock at a discount, typically 20%. The downside of convertible notes is their debt, and they have a maturity date. And so what happens, 2-3 years later, when the maturity date is coming up and you're not ready to do your next financing? So that's kind of what led to the SAFE, which is an acronym for Simple Agreement for Future Equity. And it basically works the same way as a convertible note, except there's no interest and there's no maturity date. But in other respects, it's pretty much the same. When you do a future financing, the amount invested under the SAFE converts at a discount, typically 20%, but there may be a valuation cap which would give a steeper discount. And those are really now the most common investment vehicle, up to maybe $3 to $5 million investment. So for smaller investments, and this will depend on whether you're like on the West Coast or East Coast versus in the middle of the country, you're going to do any investment rounds under $3 million probably using a SAFE. And they're quick and they're easy. But you don't want to just go to the Y Combinator website and download the SAFE that they put there and use it without thinking about it, because Y Combinator is an investor now. And they've put some provisions in the SAFE that cause, this is in the post-money SAFE, which is very common now, which causes a lot of dilution to the founders. And so if you're going to use a post-money SAFE, it's really to your benefit to engage a startup attorney who's familiar with these things, who can edit out that type of dilutive language that's in there. Too many startups, they just download the SAFE and run off and have the investor sign it, or the investor tells them to use it, and they have no idea what's just happened to them. So that's the landscape, let's say, under $3 million rounds. SAFEs are pretty much overwhelmingly common. Then there's kind of an intermediate, there's what's called Series Seed preferred stock. And it's kind of like Series A preferred stock, but the diet version. So it's the Diet Coke version of preferred stock. It's a little less complex than your Series A preferred stock. It may not have anti-dilution protection. It may not have registration rights and co-sale rights and some of the other rights and privileges that come with a full-blown Series A round. And by that token, the documentation is a little less involved, and your legal fees are going to be a little less involved, although they will be substantial. You don't want to do Series C preferred for less than maybe $3 million because you may spend $15,000-$20,000 on legal fees, and you don't want the cost of capital to be so high. So those are kind of the intermediate, and then when you get into higher amounts, you may be doing like a $5 million round. That might be a Series A, a full-blown Series A with all the documentation, the voting rights agreements, those types of things.
Yeah, no, great points. Great points. I think it's important. I mean, for founders to understand these different types of things that we've learned today, because I've learned a lot of new things. Founders, we don't know everything from that aspect, but I can confidently say that me being the host, I've learned a lot from this aspect.
You're giving away a part of your company, and if you're giving away a part of your company, I mean, you're selling it to someone for money, but you want to know what goes along with that. It's not just he's giving me $5 million and I'm giving him 10,000 shares. He's got a lot of other rights. He's now sitting on your board of directors. He has the right to veto certain transactions like a future financing or a sale of the company. So you have to really think hard about what those deal terms are.
I couldn't agree more. This was a valuable and insightful episode, and I think that our community will stand to benefit a lot from this. I mean, thank you really for joining us on the episode of the Funding Blueprint. We hope that you enjoyed our conversation with Paul Spitz and gained valuable insights into the world of corporate and transactional law for startups and small businesses. If you want to learn more about Paul and his incredible work at Kinetic Law, be sure to check out their website and social media links in the show notes. As always, we appreciate your support and invite you to subscribe, rate, and review our podcast on your favorite platform. Stay tuned for more exciting episodes where we continue to bring you stories and advice from inspiring entrepreneurs and industry leaders. Until next time.